Welcome to Amberger Smackdown at TFNFinancialNews.com. I'm J. Christoph Amberger. Despite the summer dip in US and global stocks, one thing is becoming clear. The year 2007 will be a great one for investors owning equities. There are times when I feel transported back in time to the late 1990s, where a monkey could throw a dart at the Wall Street Journal and rack up better portfolio gains than your average portfolio manager. If monkeys could be properly house-trained, I'd recommend some of my publishing colleagues should replace half of the editorial staff with them. Then and now, there are those who see one of the horsemen of the apocalypse in every percentage increment the Dow rises. Recession is around the corner. Stock markets will crash. Gold will be king. To which I say, of course, duh. Markets go up and they come crashing down again. That's what they do. But all in good time. Because this bull still has legs. It will outlive the Bush administration and then turn and gore the successor in the White House with a recession and market crash that is not of bad parents. A bear market that could last 4, 6, even 10 years. But we're not there yet. The world's growth engine, the American consumer, and his need for oversized SUVs and overpriced hybrids, for teeth-rotting candy and teeth-straightening orthodontics, for $20 dress shirts and $1,000 jeans, for $200,000 degrees in Chicano studies and $150,000 condos, for $10 jump ropes and $50 a month unused gym fees, is running like a sewing machine in a Bangladeshi sweatshop. Asian emerging markets have jumped to new record highs, partly thanks to direct demand from the United States, and partly thanks to indirect demand from China, which gobbles up forests, lakes, and mountains to turn into trinkets and television sets for the American consumer. Hong Kong is benefiting from its fixed dollar peg, is at the forefront of profits. The Hang Seng soared 25% in the third quarter, passing 27,000 level and propelling the market's capitalization about $2.3 trillion, gaining 42% between June and September alone. That doesn't sit well with those still waiting for the 1980 gold bubble to reinflate, or those for whom the ideal price curve of a market appears to resemble the readout of a heart monitor at the city morgue. One of my colleagues wrote last week, "Now the bubble du jour is in China. In Shanghai, cab drivers offer stock tips, people stand in line of brokerage offices to open accounts. China's largest brokerage, CITIC, is bigger than Bear Stearns and Lehman Brothers combined, and stocks are soaring. Now they're trading at an average of about 50 times earnings. Pretty rich. Déjà vu is a French expression, well known to investors in the West. We wonder if there's an equivalent in Mandarin." Indeed, there used to be an internet stock bubble. Property investors and speculators enjoyed the easy money generated by the real estate bubble. I would agree that taxi drivers and shoeshine boys giving investment advice are as sure an indication of impending doom as also-ran politicos getting Oscars for science fiction movies. Already, déjà vu is French, to be sure. It is also the quintessential observation that underlies technical analysis and forecasting. After all, it was the indistinct feeling of having seen something already that first led technical analysts to go back through reams of data to find the unique constellations of catalysts that invariably preceded every move. But the Frenchman shrugging his comme ci comme ça at the observation that there may be a bubble going on and that it may pop at some point or other can afford to smile at the supposed foolishness of the world. After all, he can't be fired, works 35 hours a week, spends the month of August drinking Bordeaux in the countryside, and considers his health care free because it's not his taxes paying for it. Let me give you the true definition of a stock market bubble. It's a bull market you have missed out on. Bubbles mean first and foremost that there's a lot of money to be made. The problem is you can only make it when you're part of that particular market boom. If you invest in internet stocks when investors scream for internet stocks, sell houses if property investors are buying, or make money in Chinese stocks when the Chinese are plundering their savings accounts to buy themselves a piece of Shanghai. The only people I've heard complaining about the bubble market in Shanghai are those who have missed out on that market doubling and doubling again in the last 18 months. And while the $1 trillion and counting of bad loans is looming over the Chinese financial system, there's no indication that the boom will come to an end anytime soon. Sure, it will all come crashing down, but not now. Now is the time to make money. In my monthly investment bulletin, we have been milking the Chinese IPO market for all it is worth, racking up triple-digit gains with a regularity that comes with an oat bran diet. And it's as easy as buying stocks in AT&T. A market bubble may be followed by a correction that shaves off some of the profits of a particular asset category. It shakes out the hypiest, most speculative elements, both in regard to asset quality and in view of the investors who've been piling into the markets from their cubicles, company cars, or paper route. But here's where all the backseat commentators and stay out of the market and buy gold pundits have it wrong. Knowing that each bull run is inevitably followed by a crash is like money in the bank. Investing is not about getting in at the absolute bottom and out at the absolute top. It's about locking in as much profit as you reasonably can, which means a simple trailing stop can make sure you never lose everything of the profits you made in the inevitable downturn. And if you're smart and skillful, you can leverage even the downturn into an active profit opportunity by hedging with options to the upside or downside. If market history has a lesson to offer, it is that the rewards of standing aside and wagging your head at the foolish investors making money in a bubble are ephemeral, and that bubbles are great times to make money if you remember they will come to an end, and prepare accordingly. For TFN, I'm J. Christoph Amberger.